This screencast is designed to teach you about stock pricing models, perpetual models of stock pricing. We have seen previously that the value of some company's stock is simply the value of the firm divided by the number of shares outstanding. The one example that we saw had a company that had a finite life. At the end of 3 years, the company called it quits for whatever reason. In some sense, that was a simplification of the real world. As an entrepreneur, when you create a company, you want your company to grow and to prosper and to last forever. So, really, when you price stock, you view stock as being something that lasts perpetually. Thus, our stock pricing models have to account for this idea of perpetual life. Here's our first example. Suppose you have a preferred share of Mellon Bank which pays dividends of $4.50 forever. One of the distinguishing features of preferred stock is that typically the dividends are fixed and they are paid for as long as the preferred stock is alive. So here you have Mellon Bank with preferred stock dividends $4.50 a year. If as an investor you buy this stock, you are thinking to yourself, if I don't buy this stock, where can I invest my money? So you've done your research and you've discovered that investments of similar risk are offering an 8% rate of return on such an investment. So as an investor, you're going to require an 8% return to invest in these shares. And the question is, what's the price you should pay in order to receive the 8% return? Let's view this stock in terms of a timeline diagram. Here's our typical timeline. If you buy this stock, you'll buy it today. You want to know what the price of this stock should be. One year from today, you'll receive $4.50. Another year passes, you receive the same dividend, $4.50. A third year passes, again, you receive the same dividend, $4.50. And to communicate that this type of thing goes on forever, we have this right arrow at the end of this line. And the required rate of return on this investment is 8%. Can you not view this as an annuity? It's an equal and periodic cash flow. Only thing, it's a special annuity in that it goes forever. Okay? So any special annuity that goes forever is called a perpetuity. All right, we already know how to price perpetuities. We've learned in a previous lecture that the present value of a perpetuity is the cash flow on the perpetuity divided by the appropriate interest rate or discount rate, or if you want to call it, cost of capital. Let's apply that formula to the current information. Our annual cash flow is $4.50. Our required rate of return is 8%. When you plug these numbers into your calculator, the calculator says that the price of this stock is $56.25. If you buy this stock for $56.25 and you pocket $4.50 at the end of the first year, your first year's return will be 8%. Next year, when you pocket $4.50, again the return is 8%. The third year, when you pocket $4.50, the return is 8%, and so on and so forth. Of course, as an investor, you have a finite life. This preferred stock is supposed to have an infinite life. Well, guess what? There are secondary markets for preferred stock. When you are ready, you can sell this preferred stock in the market and receive whatever the price of that stock is at that time. If the appropriate cost of capital at that time is 8%, then you will receive $56.25. So preferred stock pricing is relatively straightforward. How would the price be different if the share could be exchanged into common stock at the option of the shareholder? Frequently in the US, preferred stock is issued with the option that lies with the shareholders to have it exchanged into the common stock of that company. Under what circumstances would investors choose to do that? Well, if the company flourishes and if the price of the common stock becomes very attractive because the company is flourishing, you as a preferred stockholder can turn in your preferred stock and receive common stock of that company in exchange. The ratio at which the preferred stock is exchanged into common stock is fixed when the preferred stock is issued. So for example, some company might have a 5-to-2 ratio. So for every 5 shares of preferred stock that you have, you can turn them in and get 2 common shares in exchange. You would choose to do that as a rational investor only if the value of the 2 common stocks that you receive is higher than the value of the 5 preferred stock that you turn in. Having an option always adds value to whatever it is that has the option. Thus, all we can say is that the price of Mellon's preferred stock would be greater than $56.25 if they came with an option to have them exchanged into the common stock of that company. To figure out exactly how much more that preferred stock would be worth with the exchangeable option, one would need to study option pricing theory, which is really well beyond the scope of this course.